Morning everybody, and welcome to our Friday update at Aquila Markets on the 12th of March. And just like to remind everybody to view our terms and conditions at aquilamarkets.com before viewing any of our content. This week, what a change from last week. This extraordinary risk rally that we'd seen over this past week, we really think actually has been driven less about interest rates coming down, because they haven't. In fact, if we come and look here on the dashboard, 10-year yields are pretty much unchanged on the week, but actually just a pause in the pace of the move. The pace of the move in interest rates had gone so quickly that it was creating real concerns in markets. But a calming down of that pace, a pause, has allowed much of those equity markets to play catch up back to the top side. And of course, the other thing that we've seen this week has been the signing finally of the $1.9 trillion relief package. It's going to send $1,400 to most Americans. And what's happened this week? An enormous rally in the Nasdaq. Tech stocks led back to the upside. Nasdaq up 4.7%, and global equities have performed very well as well. And notice the performance of Bitcoin up 18% on the week. So we're back to this sense of the Goldilocks scenario. Rates are a little bit higher, but not too high. There's plenty of money around. It's good for all assets. All assets start to rally. This has been a long-term theme of ours over this past 6 months or so, is periods of Goldilocks, then it gets overextended, we pause, overextended, then we pause again. This is exactly what's happened. So that's really been the key for us this week, has been, we always view the markets as being the best source of news we're ever going to get, and I think that's exactly what we've seen this week. Next week we have two big things coming up. One is the Fed and the other is the BOJ. Let's start with the BOJ. They're going to remain very dovish. Dollar yen is trying to come up towards 110. This is a big level for us, as we talked about last week. We really like dollar yen to the upside. The Bank of Japan are going to be desperate for a weaker yen. And of course, one thing we really want to note that's just important, we don't show euro yen on here, but let's just remember dollar yen over the last month is up 3.6%, euro's down 1.3%. So there's been a net gain in euro yen. Euro yen, if you look at that chart, is just grinding its way to the upside. Be very, very pleasing for the Japanese. The Fed is a different story. Wednesday for the Fed, Friday for the BOJ. Fed's got three big issues. The first big issue, of course, is going to be this issue of the supplementary leverage ratio extension. This was something that was done during the pandemic to allow banks to hold more treasuries when there was real disruption in the fixed income markets. That is coming to the end in March. That's what's docketed to happen. One of the issues for that, of course, is that the bank's potentially going to have to sell treasuries. And in fact, we think they have been selling treasuries, and that's one of the reasons why fixed income sold off so much late February and early March and caused much of this wobble that we've seen in markets when rates just move too quickly. The second big issue he has, obviously, is the questions around inflation and how they're going to know if inflation is running too hot. And commensurate with that is going to be the estimations of the governors of the Federal Reserve as to how fast interest rates are going up, which is what's called the dot plot. So those are the three things that Powell's really going to have to do. We think there's going to be a lot more volatility to come. We just remain very tactical, and that remains our view in this market. We just have to stay very much on our toes. It's a trading market and not a trending market right now. Let's come and look at the sector leadership, and it just speaks to the strength in equities last week. Every sector is in the green, absolutely every sector, from retail at the top to healthcare at the bottom. Everything's in the green, which is always interesting to us. Growth versus value have rallied exactly the same. That speaks to the breadth of the move in markets. And if we come and look here at the regular weight versus the equal weight ETF, so obviously a regular S&P 500 is market cap weighted. This is an equal weight index. It's a great measure of breadth, and we can see they've moved virtually exactly the same over the last week. That really speaks to this idea of a very broad rally in markets. One thing I want to mention about this XRT ETF, it's always fascinating to us when we see the XRT move a lot, because the XRT retail ETF is really a lot of meme stocks, and the biggest holding in that is GameStop, which is actually 15.1% of that portfolio. So always interesting to us when we see this thing moving around, because it tells us, it's a great signal to us on our dashboard, which is how I use our dashboards, that we really have some underlying desire to get involved with those meme stocks, and it tends to mean that we're in a risk-seeking environment, and we saw that with Bitcoin too. But what I want to talk to you about today is some longer term themes. We really feel this is a great moment to do this, and we talk about a lot this ourselves. We look at these a lot. We find them very valuable to go back at when look at these charts, even though we know what the charts tell us because they're old favorites of ours. The first one we want to look at today is a chart of the balance sheet of the Federal Reserve, the ECB, and the BOJ, and we show this here in the orange line, and we can see that 20 years ago this was way down. sort of $2 trillion. Here it is all the way at $23 trillion. And just look at how this is the acceleration during the financial crisis of '08, gradual move higher, a pause, this was when the Fed was tapering, and then a big rally up here, obviously the response to the pandemic, this enormous fiscal monetary stimulus that we've seen around the globe. Plotted against this is world equity market cap in dollars. So in other words, this is on the right hand side. So this tells us that at the peak in 2007, roughly around $60 trillion was in global equities. And now, if we can come here, the key thing I want to look at is just how closely these lines track. Just look how closely this tracks. Equity gets a little bit ahead of itself and down, ahead of itself and down. This is when the Fed actually started to stopped expanding its balance sheet. We saw equities break to the downside. Notice what happens here when the balance sheets go sideways. Equities just went into this really broad range and suddenly this enormous explosion to the upside. So this idea of the scale of balance sheet expansion and the relationship with global equities is really striking. And that's why it's going to be so hard for equities to collapse while we have this situation and we don't necessarily have a big move higher in bond yields. What it reminds us, again, is this pause in the pace of the move in rates has allowed the market to catch up, but we must never forget the enormous, colossal amount of headwind that is behind assets in general to drive them higher. Now, one of the things, of course, about that, and this is a great chart that we've seen, has been this relentless printing of money has caused hoarding in financial assets but not going back into the real economy. This is a long-term theme of ours, that money printing, the debasement of currency through quantitative easing, has not helped in any way the real economy and has actually caused many of the issues that we see in the world today, including income divides and various other things like that. Let's just look at what this is. This is the total return in performance since January '09, basically the base of the global financial crisis. And we can see, if we look at the real economy, just look how this has just simply not performed in any way whatsoever. Commodities are negative over that time, which speaks to a total lack of inflation in the real economy. House prices, US wages, European wages. Let's come and compare it to the performance of all assets over here, from credit, commodities, and then various equity indices, and then this incredible performance in the Nasdaq. And of course, what do low rates do? Low rates allow companies that basically need a zero cost of capital to be able to survive. That's exactly what's happened. The globe has been living in a world where the balance between the price of labor, interest rates if you like, and the price of capital, interest rates, has been completely wrecked. And this is such an interesting point. This is one of the things that we worry about so much, that this latest action by policymakers is simply not going to create the outcome that they want, which is real inflation that's going to be beneficial to the globe. In fact, it could do something very different. And finally, one way we want to point this out today and show this is a pretty interesting chart. We show this chart quite a lot here at Aquila Markets. And which is this idea of US M2, which is a measure of broad money supply, which we can see here in blue, and the velocity of M2. That's how fast the money actually moves around the economy. How many times is a dollar recycled around the US economy? And we can see that while M2 has grown pretty steadily as money's been printed over this period of time, and then this huge explosion to the upside in the pandemic, we can notice that the velocity of money peaked in 1996. In other words, as money supply has gone up, the velocity of money, how much is being transported around the real economy, has gone down. In other words, it's been hoarded. And where is it being hoarded? It's being hoarded in assets. It's not being flowing back into the real economy, but it's being hoarded here. And so it's really important when we come and look at these charts, because we always have to recognize one thing. The financial markets and asset prices, whether or not they're targeted by policymakers, is another matter, but they don't affect the real economy. They are in and of themselves something that we like to trade, but they are what they are. And we just remember that, and I think it's just a really important message to take away from today. And so finally, the last chart I want to look at today is the Nasdaq. We obviously talked about that, and we just want to have a quick look at it this morning. We were here last week. It looked dead and buried. We were down below the 100-day moving average, and it looked like for all money we were going to go and test this level. We still could. We've had this bounce up. We've stopped just ahead here. We can see the 50-day moving average. Could we go down? Absolutely. Could we go up? Absolutely. I'm not sure at this particular moment, because these markets are going to be driven by flow and liquidity, and we have markets chasing momentum in every direction. What does that tell me? It tells me that volatility is going to stay elevated, and it tells me how we should be thinking about trading these markets. Stay tactical. We need to pick our battles. We need to, if we get in a position that's working well, trail the stop in, manage our P&L and our risk with great care, because that, I think, is the way that these markets, we're going to be able to navigate these markets. So that's it from us. Have a great weekend, everybody, and we'll speak to you soon. Take care.